Most people think a Sir Million net worth is a lottery ticket. It's not. It's a woo-step mathematical system that almost anyone can follow if they start today. Before we break down the exact year-by-year blueprint, make sure you're subscribed to the channel. We drop these wealth minutes, building playbooks every week to help you escape the Joe to woo. Now, let's look at stage E, the fortress. The philosophy of the Fortress Foundation, the most common mistake in the pursuit of a Sir Million net worth is the obsession with offense. How fast can I grow? How much can I earn? And what is the highest risk asset I can buy to moon my portfolio? However, the world's most elite financial minds understand that wealth is not a game of speed, but a game of survival. If you want to build an 8-figure empire, you must first build a fortress foundation. This isn't just a fancy term for a savings account. It is a fundamental shift in how you view capital. A fortress is designed to withstand a siege, a period where the outside world is falling apart, the markets are bleeding, and jobs are being lost. In the context of your personal finances, a fortress foundation means having enough liquid cash to cover arduous months of your total lifestyle expenses. While the average financial advisor suggests 3 to 6 months, that is for people who want to stay middle class. Those aiming for Sir's $1 million need a buffer that allows them to remain completely unemotional when the world is in a panic. When you have 2 years of cash sitting in a high-yield environment, your psychological relationship with risk changes entirely. You no longer fear a market crash, you begin to crave one. Why? Because you know that your survival is guaranteed, which frees you to use any additional capital to buy distressed assets, while everyone else is forced to sell theirs just to pay their mortgage. This is how the wealth gap is truly formed. It isn't formed during the bull markets when everyone is making money. It is formed during the bear markets when those without a fortress are wiped out, and those with a fortress acquire their assets for pennies on the dollar. Without this foundation, you are essentially building a skyscraper on a swamp. No matter how high you go, the first sign of rain will cause the entire structure to sink. The math of the fortress is also about the cost of interruption. Compounding is the 8th wonder of the world, but it only works if it is never interrupted. If you have woo-battered the stock market and a medical emergency or a job loss occurs, and you don't have a fortress foundation, you are forced to liquidate your stocks. If the market happens to be down by 500 standards that year, you are locking in permanent losses and resetting your compounding clock back by a decade. By maintaining a massive cash reserve, you protect your long-term engine from the short-term noise of life. You are essentially paying for an insurance policy that ensures your wealth-building process never has to stop. In the early stages of reaching Sir $1 million, this cash reserve might feel like a drag on your returns because it isn't invested in high-growth stocks. But in the long run, the stability it provides prevents the catastrophic zeroing out that kills most investors' dreams. Furthermore, the Fortress Foundation serves as your opportunity fund. In a year cycle, you will likely see 2 or 3 major economic shifts, moments where real estate prices tank or tech stocks become undervalued. If your money is tied up in the market, you have no dry powder to take advantage of these once-in-a-decade opportunities. The fortress isn't just a shield, it's a weapon. It allows you to be the lender of last resort in your own life. When banks stop lending and credit dries up, the person with the fortress is the only one left with the power to move. This is why the top E of earners often hold significant portions of their net worth in highly liquid, boring assets. They aren't looking for a woo return on that specific cash. They are looking for the return that cash will provide when they deploy it at the bottom of a market cycle. Plan to implement this, you must be ruthless with your lifestyle during the fortress building phase. This is often the most boring and difficult part of the dollard, Sir Million journey, because you aren't seeing the flashy gains yet. You are simply stacking cash into a high-yield savings account or short-term government bonds. Feel slow, and it feels like you're falling behind your peers who are bragging about their latest crypto trades. But while they are building houses of cards, you are pouring concrete. You are creating a base so stable that once you start adding the floors of your wealth, real estate, equities, and business ventures, the structure will never wobble. You are buying the right to be calm when the rest of the world is screaming. Okay? The E/K velocity point, why the first milestone is the hardest. In the world of wealth creation, there is a gravity that exists when you have nothing. When you are starting at zero, every dollar you earn is spoken for. Rent, food, taxes, and transportation. To build wealth, you have to fight against this financial gravity to launch your capital rocket into orbit. The E/K velocity point is that orbit. Before you hit E-byte, your money has no power. You are doing E/ba of the work. But once you cross this threshold, a fundamental law of the universe shifts, your money begins to work for you. Charlie Munger, the legendary investor, famously said that the first E-byte thing is a total nightmare, but you have to do it. He even suggested that it doesn't matter if you have to walk everywhere and eat nothing that wasn't bought with a coupon, you must find a way to get your hands on E-byte, graphic, a rocket ship labeled your net worth struggling to leave Earth's gravity lush zeros versus gliding in orbit deflation E/K prisoner. The reason this phase is so brutal is that the math of compound interest is invisible at low numbers. If you have invested and it grows by 500 a fantastic year by any standard, you have made E-byte. While E-byte is nice, it doesn't change your life. It doesn't pay your rent, and it doesn't allow you to quit your job. Because the rewards are so small in the beginning, most people lose motivation. They see their dollar-sling grow to E-byte and think, what's the point? I might as well spend this money on a new phone or a vacation. This is the trap of the low multiplier. People quit because they are looking at the return rather than the habit. At the E/K velocity point, the math begins to change. Return on E-byte, is links. For many people, that is 2 or 3 months of their salary earned while they were sleeping. That is the moment the velocity kicks in. Blends, to reach this point, you have to master the art of income stacking. Since your investments aren't making enough money to move the needle yet, your primary focus cannot be investing in the traditional sense. It must be earning. You have to treat your career or your business as a high-octane fuel pump. At this stage, your greatest asset isn't the stock market, it is your human capital. Reaching E/byte requires a ruthless focus on increasing your value in the marketplace. Whether that means getting a certification, mastering a new AI tool, or taking on a high-commission sales role, the goal is to widen the gap between what you earn and what you spend. If you earn K and spend K, you are saving K a year. It will take you years to hit the milestone. If you can push your income to K while keeping your expenses at K, you hit the milestone in less than 3 years. Damdian image, a bar chart showing savings versus investment returns. At K, savings is 500 Josujo. Of the growth, at E/K, investment returns begin to take up a visible slice. The E/K velocity point is also the ultimate test of your financial character. It is a filter that separates those who want to look rich from those who want to be rich. To stack E/Byte while starting from zero usually requires a period of monk mode. It requires saying no to the social pressure of upgraded cars, designer clothes, and expensive dinners. This is because every dollar you spend at this stage is actually costing you $10 in future wealth. When you spend on a luxury item at age you aren't just spending you are spending the Sturvor that East would have become by the time you reach retirement. Those who understand the velocity point view every dollar as a seed. If you eat your seeds, you will never have a forest. If you plant them even when the garden looks empty, you are setting the stage for an exponential explosion. Poem bien. Once you hit the E/Byte mark, you experience a psychological de-stressing. For the first time in your life, you have a six-figure cushion. This creates a confidence loop. You are no longer afraid of your boss. You are no longer terrified of a car repair. This confidence allows you to make better career decisions, ask for higher raises, and take calculated risks that you couldn't afford to take when you were broke. Paradoxically, having EBAT, Ling makes it much easier to make the next EBAT. Ling, this is the snowball effect in action. The first handful of snow is hard to pack together, but once the ball is the size of a person, its own weight and momentum do most of the work as it rolls down the hill. Ben, in the journey to Sir Million, the EBAT K milestone is the proof of concept. It proves that you have the discipline to delay gratification, the intelligence to increase your income, and the patience to let math work. Most people who reach EBAT Ling eventually reach $1 million because the habits required for the first six figures are exactly the same habits required for the 7- and 8-figure marks. The unbreakable empire, the Wu Fu Arsus Fu Sensors rule, to reach an 8-figure net worth, the rules of the game must evolve. Building wealth requires concentration, but keeping wealth requires radical diversification. Most people who strike it rich eventually lose it all because they try to use aggressive get-rich tactics to stay rich. To hit Sir Million and keep it, you have to transition from a gambler to a general. By implementing the Wu Fu Arsus Fu Sensor rule, you make your empire mathematically immune to collapse. You know, the 500 Wu single stock cap, neutralizing risk. The fastest way to financial ruin is falling in love with a single company. Whether it's a tech giant or a sure thing startup, allowing one asset to represent a massive portion of your net worth is a trap. History is a graveyard of too big to fail giants that vanished overnight. By capping any single stock at 500 Wu of your total portfolio, you delete the possibility of a total wipeout. If a company fails tomorrow, you don't lose your future, you just have a bad month. You survive because your lifestyle is decoupled from any single corporate mistake. Are the 500 Ursers sector limit defense against the crash? Owning 10 different companies doesn't mean you're diversified if they all belong to the same industry. If your entire portfolio is tied to one sector, like tech or energy, you aren't an investor, you're a passenger on a single ship. Radical diversification means ensuring no more than 500 Ursers of your wealth sits in one industry. When one sector bleeds, your other holdings in healthcare, real estate, or staples hold the line. You are building a fortress with walls facing every direction, ensuring that no matter where the economic wind blows, the structure stands firm. PEMD ascend the 500 sensor asset class maximum, the strategic engine. To hit Sir Million, you must stop trying to beat the market and start owning the market. Your wealth must be divided across 3 different engines: equities, real estate, and cash fixed income. No single asset class should ever control more than 500 sensors of your empire. Why? Because markets move in cycles. There are decades where stocks go sideways, but real estate booms. This 500 sensors cap forces you to sell what is high and buy what is low, creating a self-sustaining growth machine that functions regardless of the headlines. Lemdianth the Stoic's edge. Radical diversification removes the emotional tax of investing. Most investors underperform because they panic. When a specific market drops 500 Ursers, they sell at the bottom because they can't handle the heat. But when you are radically diversified, your portfolio never drops in unison. While your stocks might be down, your rental properties are still cutting checks. This stability allows you to stay rational while others scream. It turns a market crash from a disaster into a clearance sale. Mans the legacy transition. As you approach the Sir Million mark, your goal shifts from wealth creation to wealth transmission. A concentrated portfolio is a fragile legacy. A radically diversified portfolio is a generational engine. It's a system designed to produce significant annual passive income without ever touching the principal. You aren't just protecting your money, you are protecting your time, your sanity, and your future. You are building a fortress that grows, adapts, and survives forever. The journey to a Sir Million net worth is often romanticized as a series of lucky breaks or high-stakes gambles. But as we have dissected throughout this blueprint, the reality is far more clinical. It is a systematic evolution of your financial DNA. To conclude this masterclass, we must recognize that the transition from 0 to 8 figures is less about the money itself and more about the radical transformation of the person managing it. You began this process by constructing a fortress foundation, a psychological and mathematical shield that removed the fear of survival from your decision-making process. By securing 2 years of liquidity, you didn't just save money, you bought the right to stay rational when the rest of the world is in a state of hysteria. This foundation is what allowed you to survive the gravity of the starting line and push toward the E/K velocity point, where you transitioned from a laborer to a capitalist. This was the most brutal phase of the journey, requiring monk mode discipline and a ruthless focus on income stacking, but it was the necessary fire to launch your capital rocket into orbit. Once you escaped that initial gravity, the mission shifted from pure growth to the engineering of an unbreakable empire through radical diversification. You implemented the Wu Fu Arsis Fu Sansers rule not because you were afraid to lose, but because you were smart enough to ensure that you could never be knocked out of the game. You recognized that the ego bets on single stocks or single sectors are the primary reason why the nouveau riche often return to zero. By capping your exposure and diversifying across asset classes, you effectively became the house, a financial entity that wins by the sheer laws of probability rather than the whims of market timing. This structural stability allowed your compounding engine to run uninterrupted, turning the small snowball of your first E/K into a multi-million-dollar avalanche. Yet, even with these systems in place, the engine would eventually stall without the final and most important pillar, the intellectual act. By treating your own mind as a capital resource that requires constant R&D, you ensured that your judgment remained the most valuable commodity in your portfolio. You understood that in a world of shifting technologies and AI-driven economies, your ability to adapt and steer the ship is the only true form of wealth security. Blindy, as you stand at the threshold of this Sir Million finish line, you must realize that the bank account is merely a lagging indicator of the work you have done on yourself. The millions are simply the score of a game played with discipline, math, and stoicism. You have moved from a position of chasing the market to a position of owning the market. You are no longer looking for a needle in a haystack because you have followed the blueprint to buy the entire haystack. This is the strategist's approach in full effect, a plan that prioritizes the preservation of capital just as much as its appreciation. This Sir Million is not just a number, it is a generational engine. It is a source of freedom that allows you to reclaim your time, protect your family, and fund the projects that actually matter to you. It is a set it and forget it system that, when managed correctly, will produce hundreds of thousands of dollars in passive income every year without ever depleting the principal. This is the definition of true financial sovereignty. The final lesson of this system is that the math never lies, but the human mind often does. The mind will tell you to skip the fortress phase and go straight to the high-risk gambles. It will tell you to inflate your lifestyle the moment you hit E/K. It will tell you that diversification is boring and that you should bet everything on the next big trend. Your job is to ignore the noise and stick to the protocol. Wealth is a marathon run in a series of disciplined sprints. If you can master the 4 pillars, the foundation, the velocity, the diversification, and the intellect, then a Sir Million net worth is not a question of if, but an absolute certainty of when. You have the math, you have the strategy, and you have the blueprint. The only thing left to do is execute with the same ruthlessness that the market uses to weed out the unprepared.